We do not need to be in a hurry to adjust our policy stance. So said Fed Chair Jerome Powell as the Federal Reserve elected to leave rates unchanged and as the central bank entered what the Wall Street Journal describes as a, quote, new wait-and-see phase, unquote. Interest rates affect inflation, but they also affect the federal budget, and we're going to talk about that today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe, and this is Open Mic, where, after venting for a little bit, I take your questions. So to kick off today's conversation, here's a snippet from White House Press Secretary Caroline Leavitt's first press briefing yesterday.
Well, I think there's only uncertainty in this room amongst the media. There's no uncertainty in this building. So let me provide the certainty and the clarity that all of you need. This is not a blanket pause on federal assistance and grant programs from the Trump administration. Individual assistance, that includes, I'm not naming everything that's included, but just to give you a few examples, Social Security benefits, Medicare benefits, food stamps, welfare benefits, assistance that is going directly to individuals will not be impacted by this pause. And I want to make that very clear to any Americans who are watching at home who may be a little bit confused about some of the media reporting. This administration, if you are receiving individual assistance from the federal government, you will still continue to receive that. However, it is the responsibility of this president and this administration to be good stewards of taxpayer dollars. That is something that President Trump campaigned on. That's why he has launched DOGE, the Department of Government Efficiency, who is working alongside OMB. And that's why OMB sent out this memo last night, because the president signed an executive order directing OMB to do just this. And the reason for this is to ensure that every penny that is going out the door is not conflicting with the executive orders and actions that this president has taken. So what does this pause mean? It means no more funding for illegal DEI programs. It means no more funding for the Green New scam that has cost American taxpayers tens of billions of dollars. It means no more funding for transgenderism and wokeness across our federal bureaucracy and agencies. No more funding for Green New Deal social engineering policies. Again, people who are receiving individual assistance, you will continue to receive that. And President Trump is looking out for you by issuing this pause because he is being good steward of your taxpayer dollars.
So for those of you who are unfamiliar, Leavitt was discussing what was and wasn't included in the temporary pause that was ordered by Acting Director of the Office of Management and Budget, Matt Vaith, on Monday, the 27th. And there's a link to the description of this video and to that order in the description. That order was blocked by a federal judge before it was ultimately rescinded by the Trump administration earlier today. And prior to that order, it had received vociferous pushback from a wide swath, including Senators Dick Durbin of Illinois, Chuck Schumer of New York, and a lawsuit that was brought by longtime Trump nemesis, New York State Attorney General Letitia James. And it's perhaps unsurprising that a two-page memo was too vague and confusing for all the federal agencies to implement, and it emphasizes that identifying ways to cut waste, fraud, and abuse in federal spending is a daunting task, but it must be done. Later this year, Ray Dalio's latest book is titled How Countries Go Broke, Principles for Navigating the Big Debt Cycle, Where We Are Headed and What We Should Do. And in this book, I think it's coming out in September, Dalio examines the dynamics of debt cycles and offers insights into preventing and managing debt crises. And I actually also provided a link on how one can pre-order that book if you're so inclined. Now, prior to this, Ray Dalio, who, if you don't know who he is, he was the founder of Bridgewater. He's since retired from there. It's one of the largest hedge funds, if not the largest hedge funds in the world. He had previously written Principles for Dealing with the Changing World Order, Why Nations Succeed and Fail, which was published back in 2021. And that explored the historical patterns of national success and decline. So Dalio is emphasizing that understanding these stages is crucial for policymakers and investors to anticipate and mitigate the adverse effects of debt crises. So among the things that he talks about are red flags that are indicating an impending debt crisis. He identifies key warning signs. He talks about excessive government debt sales, what the market can absorb, central bank money printing, obviously. This is an important issue because in the past, frequently what has happened is that as sovereign states issued debt, and they had long since taken over basically the market's ability to absorb that debt, what would happen is there would be no appetite for it and interest rates would soar. Now, of course, since we had Ben Bernanke and sort of aggressive quantitative easing in the United States, what has taken place is that rather than printing money and then using those printed funds directly to pay for the government's expenses, instead the Federal Reserve was buying government debt, which is effectively money printing by another name. And, this is definitely creating a little bit of an issue. So a couple of things for us to think about here, and I included some other links. So the GAO has estimated that the federal government loses between $230 and $520 billion or so each year to fraud. Another $230, $240 billion just in improper payments was estimated for 2023 alone. We don't know exactly how much is spent on, for example, things like illegal immigration benefits to undocumented immigrants to the country. But the estimate net of the taxes that group pays is probably in the neighborhood of about $150 billion, a rough number. And I recognize that these kinds of numbers all are really hard to get your arms around. It's hard to comprehend the magnitude of these numbers. But collectively, if we just take the midpoint of the fraud number alone, and that's not to speak to other ways that we can find efficiencies, collectively, those three items that I just mentioned represent about $750 billion in federal spending alone. Now, to give it some personal perspective, consider this. There's about 107 million taxpayers who have a net income tax liability in the United States. So in round numbers, what that works out to is about $7,000 a year per taxpayer right now. Okay, so that's a pretty staggering number when you think about it. That is before benefits, employees, defense, you name it. That's a lot of waste. We need to do something about it. And if we don't, we are going to have an epic debt problem or some kind of hyperinflationary problem. So I think it's really important that we solve these problems. Now, I mentioned Dick Durbin and Senator Schumer and Letitia James. Now, these three have been essentially opponents of Trump for a long time. But I want to just bring up Letitia James in particular because obviously she's probably the face of part of his legal problems. And I want to point out that, her lawsuit, which, it may have had a legal basis. That's the first thing I would say. The second thing I would say is, her history is not necessarily one of being a partisan hack. So I want to just make clear that she has, in the course of her career, actually done things that had real benefits for taxpayers. For example, back when Mayor Bloomberg was mayor of New York, a period during which, when he first got into office in New York City's budget was in the neighborhood, I think, of about $43 billion, and I believe it was over $70 billion by the time he left. One of the things they were trying to do was implement a new payroll system. And Letitia James was one of the people who was investigating potential fraud and abuse by the contractors that were building that system. And in fact, the amount that she had identified and that she tried to reclaim was about $600 million. Now, if you think about that, that is about 1.5% of New York City's annual budget at the time that Bloomberg became mayor. And that was just for basically fraud or abuse that was occurring in payments to outside consultants to build a payroll system. So there is a lot of inefficiency that exists in government spending. And one of the reasons that this is true is because there is no natural forcing function that takes place in government the way it does in the private sector. And what do I mean by this? If you take a company that can do more with less, inevitably it will be the victor as it competes with those who do less with more. It is the reason why Walmart became the largest retailer when Sears and Roebuck pre-existed it. And so my hope is, number one, that everybody who is in government recognizes the scale and scope of this problem. We need to find efficiencies. We need to root out fraud and waste. And if we don't do that, it doesn't matter what party you are, we're going to have some significant problems. So I just needed to vent a little bit and get that out of the way. On my screen right now, I happen to have, since it is, my screen is not showing, so I've just been informed by the crack production staff, and of course they don't boot everything up on my machine, so this is clearly my mistake, so I'm going to rectify this as quickly as I can so you can see my screens, because I have a couple of things I do want to share, and I will be getting to your questions, but I had to get that out there because as we pay attention to this, whatever side of the aisle you're on, and I don't know if they can now see my screen, something we probably should have cross-checked beforehand. Okay, so this is just since 1980. This is the S&P 500, and what I marked out here were just a number of the big drawdowns that took place. Many of these drawdowns, it should be said, were precipitated by credit events. And I have said this once or twice before on this live stream, that equity markets, equity investors tend to look up, credit investors tend to look down to see whether the ice beneath their feet is cracking. And a lot of the big drawdowns that we have seen over the course of time have come from some major credit events. So, for example, in the late 90s, in here we had the Russian default and the collapse of the Asian tigers. Obviously, the GFC, which took place in 2008, we're all familiar with that. There were certainly some credit problems that were also part of what concerned investors essentially during the pandemic. This is, by the way, a logarithmic graph, because if it was not a logarithmic graph, this would just be too difficult to detect. But there have been many others throughout time. So we had what was somewhat disparagingly referred to as the pigs credit crisis that took place. That was in this time frame over here. This is when we had Portugal, Italy, Spain, Greece, etc., that were having some credit problems in the 1980s. Late 1980s in particular, well, mid-late 1980s, we had a lot of Latin American countries that had debt problems as well. So I bring all of this up because in the short term, when you get a credit crisis at a sovereign level elsewhere, it can impact U.S. Equity prices somewhat dramatically. The thing that we're talking about here and now, though, is what is going to happen to the federal budget in the United States. And if you have a currency devaluation may not necessarily have the same kind of impact in dollar terms. Because if you go back and you take a look at what happened to equity prices in Zimbabwe, not that they had a completely developed stock market in the sense that we think of it here, but they went through a period of hyperinflation, and at least in local currency terms, the stock market wasn't a terrible place to have your money. The Weimar Republic in Germany, same thing. So I would point out that one of the things that concerns me, obviously, is an event that can hurt investments simply because it ends up having a drag on the economy. That is a bad event. A worse event is a hyperinflationary event. And so that brings me to something that I forgot to mention when I talked about my acronym RISING before. So for those of you who have watched and know what I'm referring to, a RISING was just basically the broader theme of investments that I thought would make sense for 2025. And you're going to notice here on this one that it's got two G's in it, and I'm going to get to why that is. So the CNBC has this acronym game where they ask investors to say, hey, this is my best ideas for 2025, 2024, and so on. Last year it was Brave, this year it was Rising. What I outlined for CNBC, and it's nice if it's a nice, cute word, the other thing is they limit you to 6 ticker symbols for the acronym as a part of the game. Now, I mentioned when I first described what this was R was for RSP, which is the equal weight S&P ETF. I was for IBIT, which is IBIT, which is the Bitcoin ETF. S was for SCHH, which is a REIT ETF, sort of a fixed income instrument. I was for my emerging markets play, INDA, India ETF. N was for NANC, as in Nancy Pelosi, the subversive ETFs that tracks Democratic members of Congress and their respective investments in the equity markets. G was for Google, GOOG or GOOGL, alphabet. Now, why is there another G in here? Because I mentioned that last year gold was one of the things in my acronym, and that because I could only have 6 in them for CNBC, I kind of dropped it, but that I mentioned to all of you that I still was in favor of holding gold. Now, it should be mentioned that both Bitcoin and gold have been described favorably as a mechanism to deal with this large fiscal problem that governments can face, whether it's ours or any other, in Dahlia's book. Or so I've been told. I've read a summary of that book. I haven't read the book itself yet because it's not actually out. But I did also listen to him speak a little bit with one of the participants of the All In podcast, which I'm sure you guys are probably familiar with. If you're not, it's well worth a listen. So the additional G that I have in here is for gold, or GLD, if you will. Something else I forgot to mention when I brought up my acronym before is how you construct a portfolio with different constituents in it. And so what I've included here at the top, I don't know if you can see this very well. Can I blow this up? Hopefully I can. I put the weights in that I would prefer for the respective constituents of my little acronym, if you will, my 2025 acronym. So 30% RSP, 15% IBIT, 15% SCHH. Net, what you end up with. So these first two and this last one are not equities. Okay, so 15% is in my sort of REIT-ish equity, if you will, my REIT-ish fixed income, hedged fixed income asset. And this is the reason I chose SCHH or a REIT ETF as a fixed income instrument, because I remain concerned about potential inflationary pressures, something that Mark Guthner has also discussed. And I happen to just construct here, let me see if I can bring this down in size a little bit. You know, since December 31st, since I came up with this and gave this to CNBC, but inclusive of my 10% allocation to gold, this is the performance of the rising acronym relative to SPY. This is total return basis, so this is inclusive of dividends theoretically reinvested. And I wanted to give you guys these weights because otherwise what could happen if you just take a handful of good ideas and you say, okay, I'm going to throw 20% at Bitcoin, I'm going to throw 20% at gold, or any single stock or something like that, you may end up with more risk than you want. So RSP is a diversified equity ETF. NANC is a somewhat less diversified equity ETF. SCHH is a diversified REIT ETF. Google is not diversified. I don't necessarily advocate investing more than 10% of your portfolio in any one stock at any given time, unless you happen to receive it because you're an employee of the company. That often happens. People end up with concentrated equity positions because they receive employee stock grants. I'm sure that was true for a lot of NVIDIA employees and so on. Okay, so I just wanted to sort of tie those things together. It's going to be very interesting to see how Washington manages to coordinate their efforts to tackle challenges that face us all. And my hope is, we will see, but my hope most certainly is that the media, as they cover this story, remember that this is an important objective for all of us. And it has huge implications, because whatever your priorities are, whatever you think the government should do for any or all of us, we need to have some measure of fiscal responsibility. We don't have to have a balanced budget necessarily, but we can't run deficits the way we have been indefinitely without causing huge problems. So I just thought I would leave that. So that's my vent for the day, longer than usual. Okay. So let's take some questions. And the first one comes from PC. Hi, Mike. Your opinion on Microstrategy, 2.5 million perpetual strike preferred stock with an 8% dividend. pricing tomorrow at 100. Yeah, so this is an interesting... Okay. As I previously described, effectively what's going on here with Microstrategy and their securities, they're non-equity securities, these hybrids. So that would include convertible debt. Preferred is also much like that. You know, what Michael Saylor is taking advantage of here is that he's essentially a volatility seller on his own equity. Okay. So, yeah, somebody was just asking me for those allocations for rising again. Let me bring that back. I'm just going to show... I'll just show that. So we can leave that up on the screen for just a second, maybe, so people can see it. Let me blow this up a little, and hopefully, there we are. So along the top here, probably hard to read. It might be. So I'm going to read them off. Equal weight S&P, 30%, 15%, IBIT, 15% SCHH, 10% INDA. Now, this I think is probably not an unreasonable allocation. Whatever your strategy is, you probably want to have some international exposure. Mine is a little bit more concentrated than you probably might think of otherwise with INDA, which, by the way, is also the worst performing constituent in this acronym so far this year. 10% to NANC, 10% to Google, it doesn't matter, GOOG or GOOGL, and 10% gold. So I hope that helps, and you can rewind this after we're done today, or play it back at a slow speed and get all of that. Okay. So going back to MicroStrategy very quickly, Michael Saylor is able to issue these hybrid securities because he is taking advantage of the fact that Bitcoin is a volatile asset and MicroStrategy is a levered holder of it, and therefore it is going to have a higher volatility, which is the reason why he can do things like issue converts, zero coupon converts, with a 50% higher conversion price than the prevailing stock price at the time of the issuance. What does that mean? What it means is that the volatility of the underlying, in this case, MicroStrategy, is so great that options are extremely valuable on it. So even a 50% out of the money call option, if it happens to be very long, has a very long maturity, as some of these do. So let's just take a quick look. We're going to go to the debt. We're going to the bonds here. So these are the, not all of them are zeros, by the way. Some of them have very low coupons. So you can see that there's 2 zeros here. One of these matures in February of 2027, so about 2 years away. One is December of 2029. And so these are all of the convertible debt. And essentially, he doesn't have to pay very much in terms of interest on these bonds because the people who are interested in buying them are buying, among other things, essentially a call option on MicroStrategy. And MicroStrategy is a very, very, is going to be very expensive. And essentially, they're willing to lend him the money at no interest in exchange for that call option. And effectively, for owners of the shares, what that means is if he issues $1 billion worth of debt with a 50% higher conversion price, and he uses that to immediately go out and buy spot Bitcoin, then effectively the equity holders, what they get is the first 50% of price appreciation on Bitcoin for that $1 billion that they acquired. Why would basically the lender, the buyer of that convert, do such a thing? Why wouldn't they say, well, I want to have the first 50%? A couple of reasons. And who are the participants, right? So you've got fixed income investors, folks that cannot go out and buy spot Bitcoin and cannot buy equities, including MicroStrategy. So they're a natural buyer for this kind of a product. Who else would be a natural buyer for this product? Well, people like me, or at least who I used to be, vol traders. So if you're an options market maker, if you do convert arb, you understand the value of these options and you hedge them. So you buy the converts, you know you have an embedded call option. So you are now long Vega, long Gamma, long Delta, and you hedge it accordingly, and you look for opportunities to spread that out either in options on MicroStrategy or in related areas of the space, like IBIT options, things like that. So there is some statistical arbitrage that market participants who are suitably capitalized can employ against those converts. So there's a lot of vol traders in there. That's going to be your Citadels, Susquehannas. My former firm, I didn't ask them whether they happen to be in MicroStrategy converts, but it would fit. So they would certainly, D.E. Shaw. I knew guys that worked at D.E. Shaw that worked in ConvertArb. So those are the kinds of places that would be buying those kinds of instruments. There's another benefit, though, to market participants who say, I want to have some upside. I want to have some leverage associated with MicroStrategy, and that is that you're senior in the cap structure. Debt gets money before equity does. And that is also true, by the way, for preferreds. So if you have preferred stock that's paying an 8% dividend, you are senior in the cap structure to the common shares. So those are reasons why people would buy these things. Would I buy this? The preferred is not for me. My thinking on this is that for Bitcoin exposure, I don't mind having linear exposure, whether it's either through IBIT or some other means. I think that's fine. If you want nonlinear exposure, then you probably should come up with an option structure on IBIT. And, that's totally fine. There are, like I said, there are market participants who are going to create plenty of appetite for any of the hybrid securities that Michael Saylor decides to issue because they play in that space. And by the way, if you are buying preferreds or if you are buying converts and you are one of those participants, you're not necessarily making a play on Bitcoin one way or the other. You're just trading volatility. So you're buying optionality through the convert. You may be selling that and creating some basically open interest, taking the other side of retail flow in MicroStrategy options, if that makes sense. That said, I have said before, and I repeat it now, that for the moment, barring something really big and unforeseen, the two big things would be either regulatory, a sudden reversal in position by government, or a big technological innovation on the quantum side that jeopardizes mechanisms for keeping these things secure. I do remain positive on Bitcoin and positive, obviously, on gold. So I hope that helps. All right, so let's move on. Steve Garcia, hello from foggy San Rafael. Near-term NVIDIA vol is extremely rich, implied volatility 94%. I am selling strangles, the weekly 115, 130. That's tight. It's a tight strangle with the thing moving around the way it has been. Against, you own longer dated calls though. Okay, yeah. So I think that is okay. So it's not naked. It's not a naked sale. I will say this. Let's take a look at this right here. Okay, so we're just going to take a look at a chart of NVIDIA. I would like you to contemplate the following, which is there potential risk for NVIDIA to the downside? Based on what we first heard from DeepSeek, and by the way, our senior producer, Jay, who is in my ear, but you cannot hear, who is much more technologically savvy than I am, has been using and playing with the DeepSeek app, not the phone-based app, but he's uncovered some some flaws, shall we say. It hasn't overwhelmingly impressed us, basically, with some of the answers it has come back with. It scores very well. We know that. That's common knowledge. But it is still making plenty of the same mistakes. Something else, of course, which I'm sure you all saw, which is that Microsoft and OpenAI are probing whether or not DeepSeek basically pulled down data inappropriately in violation of the terms of service with OpenAI. Now, DeepSeek has admitted that they are essentially, improving on, developing from some of what OpenAI had already done. Whether or not they were stealing more than they were entitled to take as a part of that process is something that we'll probably learn sometime soon. The administration has also come out, probably because behind closed doors, or maybe not even so closed doors, there has been conversations about whether or not DeepSeek had access to technology that they weren't supposed to have. And they have talked increasingly about making the restrictions on Chinese access to some of, for example, NVIDIA's latest technology even more stringent. And then in the midst of all of that, we had Alibaba come out and do a drop and make claims that their product is, in fact, better than DeepSeek. Well, I think we're going to see some of this work itself out in the coming days, weeks, and months. But the takeaway for us as you think about selling strangles on something like NVIDIA is, can this stock reach new all-time highs underneath the cloud of all these other things that are going on? And the answer that I would suggest is no. So I think that the risk of this thing blowing out to new highs, and the highs we can see here, 153 back on January 7th, I think the risk of new highs for those of you who are going to be short premium in the thing is relatively low. Do I think there's more potential downside? Potentially, sure. I mean, NVIDIA still has, this is an important thing to think about. NVIDIA has the best technology in the space at the moment on the hardware side. It doesn't really matter what you think of DeepSeek or Alibaba or OpenAI or DeepMind. Pick your poison on the AI solution side. The fact is that those that are buying these products from NVIDIA still want them. And, one of the things I tweeted out yesterday is that necessity is the mother of invention. Whether they took things inappropriately or not, the founder of DeepSeek did specifically reference that they were put upon by the restrictions of not having access to the GPUs that they wanted. And maybe they had access to more of them than they claim. So at the moment, the demand remains very high for NVIDIA's products, and I believe it is going to continue to. And so as you think about it, it's not like the demand for this falls off a cliff. There's a lot more work to be done. They are the best of breed. It's not massively expensive if they can hold up to their 2025 numbers, although I would say, and I encourage you guys to go back and look for this. So Dan Niles, he runs a hedge fund out here. He's talked about this somewhat extensively. He has thrown a little bit of cold water on some of NVIDIA's numbers. But you put all of these things together, I have a really hard time seeing fresh highs for NVIDIA anytime soon. Which means selling upside, whether you own the stock and are interested in selling covered calls, and now that implied vol is higher, how much higher? Let's have a look. I think that could make some potential sense. I would, if I was long the stock right now, if you are long the stock, and I'm not, I would contemplate quite seriously whether you might do something like a put spread collar. I'm going to show one of those in just a second. But this is what you're looking at. Let me get rid of the realized volatility because that's less relevant. What is more relevant is how much premium you're actually going to be collecting. So something like a put spread collar might be a decent way if you're uninterested in holding your stock, which you may not be. Bear in mind that I'm not going to provide a whole lot of stock advice. Everybody's situation is different. You may be in a taxable account. You may not. Depends on where you are. These things can have tax implications. So just remember the following, which is that if you are in a taxable account, there are circumstances where the IRS can view certain hedging strategies as something called a constructive sale. And a constructive sale effectively means that what could happen is that you may essentially reset a long-term gain to a short-term one. Do your own homework based on your own circumstances, but I just want to bring that to your attention that, what I'm about to illustrate, these types of things can have implications, so it's important to keep your eye on that. So let's just construct one really quickly. I'll use options play to do this. By the way, I wanted to show you guys something from Unusual Whales, which I'm going to see if I can pull this up. I should have left it up. But a really cool feature that I hadn't shown you all before. I often talk about implied moves and whether or not the options are implying moves that are as big as what actually happens. And the folks at Unusual Whales showed me some functionality that they have, which I think is really slick, because what they did was they actually have a column chart, and hopefully I can find this thing. And if I don't, I will do this in a future live stream. But what they did was that they track. Now I have a separate spreadsheet where I calculate historical implied moves, and I can go back any number of quarters that I choose. But they have a way that they just represent this graphically, which is how big was the implied move the last 4 quarters or 8 quarters or 12 quarters, and how much did it move actually. And it's really interesting because over the last 8 quarters, so we're excluding today, and we're going to take a look at what happened there, the move was always larger than the implied move for each of the last 8 quarters and for 11 of the last 12. So kind of consistent with what we were talking about on Monday. Michael Walters asking, how do you calculate the implied move? That depends. I'm going to get to that in 1 second. So let's just take a look at the NVIDIA collar idea first. So I'm just going to go out. Let's just go out far in time, because I think it for illustrative purposes, it's going to be a little bit better as we think about this. So I'm just going to modify this one. So is this okay? I've got, all right, let's modify this jobby. Stock's about 120 bucks. We're going to do this in such a way that we can keep the math pretty easy. Let's assume that we're concerned about, call it a 25% decline. So we'll call it 124.75. So we really want to get down. Well, this is probably fine. 120.95 put spread. And we're going to sell an upside call against that to try and get that premium down to something palatable. So we can sell an upside call. And maybe we can pick something like this one. All right. And then we'll add the stock in. So here's what ends up happening, right? So let me get rid of the stock first so we can sort of see this. That whole structure, this one right here, you're putting on for very close to no premium. In fact, you're actually collecting a little bit of premium here on this. So maybe I can just notch this down and go to, let's make it the 90s. What the heck? There we go. Okay. So now what's happening? You're getting a downside put spread, the 120.90, which is going to be worth as much as $30 to the downside button. To the downside button, to the downside. So $30, 25% downside protection. And you still get participation up to here. Now, to illustrate how that's true, I have to add the stock back in. So this is what your collared position is going to look like. Now, this little bit of red that you have here, that's simply because the stock's trading 123, 124-ish. You're long the 120 put. If you were able, you could modify that and do an at the money, arguably, if you really wanted to sort of get it right up here. And then we have to do a little bit more tweaking so that let's see, go like this maybe. I can take this up maybe to here or thereabouts. Now you can see, you can play with this depending on where prices are at the time that you do it. But you can see now you're getting downside protection. You basically have no downside losses here. You have a certain amount of upside here. And then, of course, you're taking risk below whatever strike it is that you're short. So 90 bucks a share, to put things in perspective, that is going to represent a valuation of... That's going to be a valuation of about just under 2.2 trillion. 2.2 trillion. And just as a reminder to put things in perspective, the estimate for full year earnings as of the end of this month, which is really, so it's really calendar year 2024. This is being described as their fiscal year 2025, but it's really calendar 2024. So if they hit that number,
well, I think there's only uncertainty in this room.
73, that's going to be, So that's a 3.5% earnings yield on that downside risk. So that's a way you can think about it. If you put this structure on, effectively, the worst case is that you own it at a $2.2 trillion valuation, and you're going to, on a trailing basis, that's 30 times trailing. And if they're able to achieve the $110 billion or so in net income that the street is anticipating for the next calendar year, described as fiscal 2026, but it really only ends in January 2026, so I like to think about that as 2025, then what you're talking about is 22 times forward. That's your downside risk. If you have the stock through January 2026 with this put spread collar, your downside risk is that you own it at 22 times full year 2025 estimated earnings plus a month, January. Okay, so hopefully that helps out a little bit. Okay, so next, implied. Somebody was asking about the implied move. Where is that? How do you Michael Walter. How do you calculate the implied move? Okay, so implied move, there's two ways to calculate it. One is more complicated, one is less complicated. Usually when we talk about the implied move, let's say I'm just talking about the implied move, we can take a look at Tesla. By the way, what happened to Tesla? Because they reported. That's holding up. It's still about $400, which is about where it was when we talked about it on Monday. So the news couldn't have been absorbed too badly. So their fourth quarter results fall short of Wall Street estimates. This is interesting. I don't know if you guys happen to see this, but both Tesla and Elon Musk posted a produced video of new Teslas rolling off the assembly line in Fremont and driving themselves to the delivery docks. So it struck me as I saw that and I thought, well, if the numbers weren't going to be that great, now would be a really good time to sort of highlight how your technology is better than everybody else's and to highlight the promise and potential of things to come. By the way, all of you know, I'm a fan of Tesla, big fan of Elon Musk. We are on our second Tesla here. That's my wife's car, actually. I love the full self-driving. We didn't buy it as a portion of the car. You can take it as software as a service and get an add-on, and they periodically let you demo it. And we had a demo. The only reason we don't have it, because I thought it was really cool, is that my wife doesn't like it. She doesn't feel comfortable letting the car drive. I think it's awesome, personally, for what it's worth. So the implied move, if you are trying to do it for the end of the week where earnings are going to take place. So this is the simple back-of-the-napkin technique for calculating the implied move. And I'm going to just take a look at the at-the-money straddle for the week that will be. So we're going to have a put, we have a call, 380. Stock was about 390, so this should actually be 390. 390, buy the put, buy the call. There you go. So the implied move as of today's close for the end of the week was 36.35. That's using the mid-market price on a $390 stock price. So then you take that, 36.35 a share. You can divide it by the share price if you want. That's 9.3%. That's higher, by the way, than it was when we talked about this on Monday, when I think it was closer to 8, if memory serves. So that is the quick and dirty way to do it. If you are calculating historical implied moves, this is a slightly more complicated process. Effectively, what you need to do, and I'm not going to be able to explain all of this now, you need to establish what baseline implied volatility is, and then you take a look at options that capture upcoming events. So let's see if we can see this in NVIDIA. This might be kind of interesting. So they're going to be reporting at the end of February. So let's take a look here. So what you have to do and there's a little bit of math involved, is that you have to essentially calculate baseline volatility, and then you take two different expirations. In this case, we could take two different expirations that actually capture the event. So that would be this one here, because remember, it's going to be end of February. So this is end of February. We have an implied volatility of 73, 74-ish. And then take the next one. All right. We'll say it could be March. Let's go out to April or May. Okay. And you make an assumption. And that assumption is that there is a baseline volatility that should apply to options in general. And then there is an event variance that should apply to a specific event. And then essentially you use an average of sorts and you solve for the odd day. So in a very simple way, you can imagine this. Imagine, and the math's a little bit more complicated, and I have some formulas in a spreadsheet. Maybe I'll take a look and see whether there's a simple way I can share this. So, but for your intuition, imagine this. Imagine that volatility is 30% most of the time, or all of the time other than when there's an event, and it is twice as much when they have an event. And actually, it could be more than that. You could think about this and normalize it two ways. You can either normalize it in terms of volatility, or you can normalize it in terms of days to expiration. But effectively, what's going to happen is you can then back out what the excess is, because maybe one option has 21 days to go to expiration and is a very high volatility, and then you have one that's got 71 days to go and is a lower volatility, and you can solve for the odd day. Now, in truth, it isn't quite as simple as that for a couple of reasons. Number one, the constant volatility assumption is itself a little bit flawed. It's generally okay for this purpose, but volatility is not completely constant regardless. It's not like there's only earnings vol and only not earnings vol. So that's a little bit problematic. But that's sort of the way that you do. That's an overview of how you do the math. And so in my spreadsheet, for example, I was always doing 30 and 60-day expirations that capture the event. There are ways to also do it by taking a look at options that expire prior and just after. Again, making that same fundamental assumption, which is that the underlying volatility is constant and that there are these discrete events that we can identify that account for differences and then solve. So I hope that helps. I'm reasonably certain that it's an approach like that. I don't know exactly what Unusual Whales is doing in their technique. I'm assuming it's something like this because it's a fairly standardized approach. But that's the general sense of it. So I hope that helps. For your purposes, and there's utility in this in another way. If you know what the baseline volatility should be. So actually, let's take a look at it this way. Let's assume that options are fairly priced in the general case. I'm not saying, and NVIDIA is probably not the best example. Let me pick something a little bit more stable, where this will probably be a little bit easier to illustrate. Will this work? I'm only going to pull up AT&T because I happen to notice that the thing's up a ton off of its lows, which I thought was rather interesting. So let's see if we can break out some seasonal impacts. Okay, so here we have it. And let me put some 1 month options in here too. Okay, so if you see, this chart probably doesn't look like much at first glance. But when I make some points about it, some things will probably be easier to discern. Notice that you have these periods. I'm going to look now at historical volatility. You see these big humps that are taking place here. Here, here, here. What are these? I haven't even mapped these to when the company reported earnings, but that's almost certainly what they are. You can see that with almost metronomic regularity, you have these sudden big spikes in realized volatility. And what's going on there, and this will become even, the shorter I make these realized volatility calculations, so now it's just 10 trading days, 10 sessions, the more pronounced that's going to become. Now I'll do 5. Watch this. See those spikes? So what's going on here? Okay, and what I'm being told is that I'm getting some lag on my screen share, so I'm just going to kill a bunch of nonsense that's probably... And actually, as I kill things, one of the other links that I think we provided in the description below, which if you haven't used it, U.S. National Debt Clock, it was created by the Peterson Foundation. The Peterson Foundation was founded and turned by a guy named Pete Peterson. So Peter named his son Peter also, so there's a lot of Pete Petersons. Peterson. Pete Peterson was the co-founder along with Steve Schwarzman of Blackstone. And he retired many years prior, and he set this foundation up because he, like Ray Dalio, and Ray Dalio has said that he's writing these books, and Pete Peterson created his foundation because both of them shared the same concern, that we did not have any level of fiscal responsibility, and they're trying to do all they can to promote it. The U.S. National Debt Clock, sponsored by the Peterson Foundation. I think we have a link to it. You should take a look at it. It's very cool that the way you can distill information in there. Like it a lot. But yeah, that's something well worth looking at. Okay, so what we're dealing with here, these spikes, those are these events, right? So the big spikes are probably earnings-related events. So if you can assume that the underlying volatility process, that there's only 2 kinds of volatility processes for a TNT, and that they're generally continuous and generally consistent, then the other thing that this has utility for is that if you know that an option you buy that expires in 60 days or 70 days or 80 days or 180 days includes an event, and you know what the underlying volatility should be without that event, then you know that implied volatility will fall after that event takes place, and you can begin to estimate what the vega loss on that long options position will be after the event comes and goes. So you can imagine that in the case of Tesla, so far at least, see where it's trading, it's essentially unchanged in percentage terms. So if you owned options, including the put spread that I talked about as a potential hedge on Tesla going into the event, if you bought that, now in the case of the trade that I talked about, the hedge trade, I said all you're trying to hedge is just the event in case it turns out disappointing. You know how much you're going to spend, and it's either going to make that money or it's going to lose that money by the end of the week. And so it is true. But if you had bought longer dated options in Tesla to hedge, and somebody asked me about this, the issue you're going to have is the stock's not going to decline, but implied volatility is going to fall. We call that sometimes vol crush, vol suck, whatever. Implied volatility goes down, your vega, your net vega, is going to be your instantaneous loss in the event that implied volatility falls following an event, because those options now no longer include it. Starting tomorrow, a 60-day strangle in Tesla doesn't include this earnings. So that catalyst is come and gone. Its potential contribution to volatility is gone, and options prices will fall to account for that. Okay. Let's see what we have here. I prefer an ETF named Mike rather than Nance. I'll tell you, I've run an ETF. It's not a great business. I mean, the issue with ETFs, if you're thinking about it from the money manager's perspective, is that there's a lot of compliance and regulatory expense associated with it. I conservatively call it $1 million a year just to run an ETF. In terms of your legal, your accounting, your service providers, all that kind of stuff. You're just not going to get out of doing it for probably $1 million a year or less. They are 40 Act funds, which means you cannot charge a performance-related fee. So you can't have a performance bonus associated with it the way a hedge fund can. So if you have a 20% year or a 35% year, the way I did last year, you can't take 20% of the 35%, which would have been a 7% fee, which would have been nice, $70,000 for every million that you manage. So you don't get that. And it really is, it's a tough business. There's a lot of filing requirements, and there are restrictions on the kinds of things you can do, and it's very difficult. Our ETF, for what it's worth, wasn't able to trade options, so that can be a problem. You can create them so that they do. There are restrictions on how much concentration risk you can take in financial-related companies. So Berkshire, for example, was a company I liked a couple of years ago, owned it, and depending on how you characterize it, that was considered a financial. So because it was a financial, we weren't supposed to own more than 5%. And it's a diversified financial, even if it is one. But depending on how compliance reviewed it, we couldn't own more than 5% of it. Which is kind of extraordinary now when you think about it, because not only is it a conglomerate, in my perspective, largely insurance, but it's a conglomerate. It's also 30% cash, like Berkshire, by the way. So just something to think about. If somebody wants to seed an ETF, for me, called Mike, happy to manage it, but it's got to have at least $100 million in it, because $100 million at a 1% management fee is break even. That's how tough it is. Oh, that brings up an interesting point. I don't know if I mentioned this on Monday. I think I did. VOO, yeah, I'm pretty sure I did, because I happen to notice that the Vanguard S&P 500, that's the cap-weighted ETF, and I'm more of an equal weight guy right here now, for the reasons I've previously discussed. But if you are a cap-weighted S&P holder, own VOO instead of SPY, they charge much lower fees. Okay, hi Mike. What's the best practice when a covered call is deep in the money and you want to keep the stock? Any rules, best practices? I'm basically jumping into this circumstance from the side, meaning that I don't know when that call was sold or how deep in the money it is or anything like that. So let's break this into two parts. Part one, when am I interested in evaluating whether or not a covered call probably deserves to be adjusted? And I've said on previous live streams that my alarm bells start going off at about a 60 delta. So if the call option gets to a 60 delta, that means that the probability that that call is going to end up in the money statistically, barring you have some event coming up, is better than a coin toss, right? So it's now more likely than not that that call option is going to end up in the money. And if your objective is to simply try to collect extrinsic premium, the other thing that's true is the extrinsic premium you're now collecting is less than an at-the-money option would have. Now, there's something else to think about. If the stock you own pays a big dividend and that call is in the money, there is a chance that you will have the stock called away from you before the ex-dividend date, if the net present value of the dividend as of that day prior to the ex-dividend date is higher than the extrinsic value of the strike. I realize this sounds really hard and convoluted. I'm not trying to be. Probably AT&T is a good example because it pays a handsome dividend. Let's see when the next one is. So they're going to be, and I just happen to be talking about the stock, might as well not jump around too much. So the next dividend is going to be, the next ex-dividend date is going to be on April 10th. Okay, so it has a dividend of about 28 cents. Okay. So now let's just take a look at some options that capture that event that are in the money. And by the way, what I'm about to explain to you now will help you understand one of the interesting things that will happen in cases like this that some people may not know about, which is that sometimes right before a stock goes ex-dividend, you're going to see tons of calls trading, tons of them. And you're going to think, oh, is everybody bullish on the stock? Yeah, no, that's not what's going on. Basically, people who are in the market making game, people like myself formerly, are angling to try to capture the dividend. Okay, so let's take a look at some stocks that are early. These calls are already early exercises based on, they're not going to get exercised prior to the ex-dividend date, but they are certainly candidates. Consider this. So if we are looking here, I'm just going to check on my little monitor just to see how far behind my screen share is. I'm not sure why it is. Okay. So if you are looking at this first batch of options up here, this is the open interest. for the April 20 calls. The April 20 calls have 4,300 contracts or thereabouts. The 21s have 4,900. The 8,800 on the 22s. Take a look at the value of all of these corresponding puts. So those three strikes have extrinsic value of less than 28 cents. How do I know that? Because the puts, the 22 puts, are offered at 27 cents. So clearly they have extrinsic value of less than 28. And of course, therefore, every lower strike put would also have a lower extrinsic value. So that's essentially the bogey that you're trying to estimate. So those calls, the April 20s, 21s, and 22s, if you happen to hold them, if you're long them, you don't want to ride that through the April 10th ex-dividend date. So if you owned them, you would either want to sell them or exercise them on the 9th so that you would own the stock and capture the dividend. Otherwise, what's going to happen is the stock's going to fall because there's no arbitrage, all else equal by the amount of the dividend on the ex-dividend date. So when you see a lot of calls trading ahead of the ex-dividend date, keep your eyes open. What you're going to find is that a lot of them are focused on strikes where there's a lot of open interest. And what the market makers, my former hat, what we were doing was we were kind of banking on the fact that people didn't understand this dynamic. They didn't recognize that they should be exercising these early to capture the dividend, or that they were essentially forgoing that value. And so our objective would be to be short as many of those calls as we possibly could, and hope that people didn't have the knowledge that they were supposed to exercise those early. So I don't know if that's the case here, where you're talking about being short in the money calls, but I'm talking now about calls that are $2, $3, $4 in the money. These ones still have almost 80 days to go till expiration. No one's going to exercise them early, and you should never exercise it before the last moment before you make that determination. So if it's going to be ex-dividend on the 10th, then you need to make your determinations and decide how you're going to trade it on the 9th, because as of the 10th, it's too late. And you never want to do it early either, because what if the stock falls or something like that? So you have to time it. Now, on the put side, there's a similar dynamic related to the cost of carry, but it's not as time sensitive because, if you miss it by a day, if the cost of carry of a put exceeds the extrinsic value, you don't necessarily exercise it early today, because all you're going to do is lose the cost of carry from one day to the next. That's not a huge thing. But on this side, absolutely. So 60 delta. I hope that helps you. Use that as and you can pick your own. But to me, that once you start getting into that 60+% chance that the thing is going to expire in the money, probably a good idea to start thinking about what you're going to do. And then obviously if there's an ex-dividend date coming up, even more so. PC asks, I have a strangle swap on IBM Feb May 210-245 for a net debit of 10. IBM is now 250. So you're riding right along the... So here's the question on your strangle swap, which is, what do we have for events coming up in IBM that could impact that? So you own earnings. You own the earnings move, and you're short the Feb 14s. Is there any value to those Feb 14 downside puts? I'm guessing those Feb 210s are probably almost worthless by now, right? The stock trading 250? No, not quite. You still got a decent... Oh, I'm actually surprised. Why? Oh, it's a 50 vol. Yeah. Okay. Well, this price right here, this can't be where these things were trading. I can't imagine this is where they were trading well before the close. Let's take a look at that. So 194.35, that's a wide spread. You kind of want to watch out for nonsense like that. Where were these things trading? Okay, I'm being told that my desktop share is not working very well. I apologize for that. I'm just going to take a quick peek and see where this thing was trading 30 minutes before the close. Okay, so this was it was reasonably tight. It doesn't matter if you can see my screen or not. I just wanted to see. They were about 25 cents wide prior to the close. So, I mean, right now you're actually collecting a decent amount of decay still on those. And you're basically, the way I would look at 250, 245, you're essentially just long and at the money calendar spread. I might contemplate adjusting the downside put because on the long end of this trade, and ratchet it possibly a little closer so you can work it into a diagonal or something like that. Not a whole lot. Those things are going to start decaying more rapidly because they're going to be a higher vol. They're further from the money, so their decay rate's relatively high. So I'm talking now about those Mays that you own. And also be very careful about that upcoming catalyst. And I'm just going to quickly check, are there any others that you want to be aware of on the horizon in IBM that could impact you? So that one also has next dividend date on the 10th of Feb, but that's not really a big date. But next week, there's a potential mover. Investor Day on the 4th. So that Investor Day certainly can move a stock. It's another one of those events. And that's why I said that simplification about there's a baseline volatility and then there's earnings. Yeah, it's not quite as simple as that, But I was using it as essentially a guideline. So, this is a nice steep downward sloping term structure for you as well. I think you can probably continue to hold on to this one for that reason. Okay, Steve Garcia. Same with my wife. She gets scared when I let our Tesla drive itself. I think it's quite safe. Yeah, you got to cover the brakes, cover the wheel just in case. And Steve, I think. Oh yeah, so you live in Marin, so the dodgiest place. If you happen to live, for those of you who ever if you come to the Bay Area and you go over the Golden Gate Bridge, you're on the 101. There's something called the Robin Williams Tunnel shortly after you come over the Golden Gate Bridge. And number one, the lanes get a little bit narrow. They get a little bit narrow on the bridge itself too. But if you're coming south on the 101, the road, the freeway, the highway really, it bends slightly to the right as you approach the tunnel and then goes immediately to the left as you come out of it. That's a pretty tough spot to have a car drive itself without getting a little anxious. I have a good friend of mine. He works for a hedge fund in San Francisco. He commutes in every day. He has a Tesla Model S Plaid. He lets the thing drive itself, and he tells me that's the one place where it's every day is a little bit of a nail biter, and he's paying a little bit closer attention. But I will tell you, if you haven't experienced it, the Tesla full self-driving is pretty slick. Okay, and I recognize that I have taken up more than an hour of your time, and I appreciate all of your patience for those of you who stuck with me, especially with all of my fiscal rant at the beginning. Michael Anthony also says, AT&T, I don't understand why shares are selling off when the company had a great quarter and lots of upgrades. Well, first of all, it's done very well off the bottom. Let's be clear about that. This thing bottomed out a while ago, and it's absolutely crushed it. You can take a look. This thing's up 50% since in less than a year. So it's one of the best performing stocks around. And that, by the way, is not the total return. That is the difference in price. It's up 50%. The total return is significantly higher. So we can just take a very quick look at that. I'll just put tax day from last year in. And you can see that the total return is actually 55.5%. The issue that AT&T has, is that it is a mature company and its legacy wireline business is a decaying business. It's kind of like, the cable broadcasting companies. It's just secular shifts. What consumers are buying and how they're buying it is changing. It's a problem here. It's an even bigger problem, I believe, in South America, where but the cord cutting on the wireline business is a big problem, and they've had to preserve that. It's capital intensive, so that's really one of the issues. And the company carries a ton of debt. Now the dividend's well covered, and they did cut, but the thing's got $150 billion or thereabouts in net debt. That's a lot, right? So if things go south, and it's not growing even with the pace of inflation. So it's a decaying business. And I'm going to just end with this one. PC says, Mike, is Governor Newsom your neighbor? Kind of. He doesn't live that far away. He lives in Kentfield now, or he just bought a house in Kentfield. He was looking at houses that are very close to where we are. From where I'm sitting, about a mile in that direction. 45-degree angle. I'm pointing. He looked at a house that is about a mile away. How I know he was looking at that, I'm not going to get into the details about how I know the specifics, but they looked at that place several times. But I think he wanted to live in a place where my understanding is there was a little bit more privacy. I mean, there was a very private spot. It's just hard to get into and out of privately, if that makes any sense. So there's no way anybody could ever see his house from the road or anything like that. But if you're a public figure, ingress and egress without being detected is important. And maybe it wouldn't have been as easy to do very close, because I'm relatively close to the water. So if I could probably hit a driver into the bay from our front yard if I really flushed it. So yeah, he lives relatively close by. So Kentfield's about 5-6 miles. One of my kids went to school in Kentfield for a little while. There's a high school there named Marin Catholic, and one of our kids went there for a couple of years. So with that, I'm sure you guys aren't even remotely interested in any of that, so I apologize. But I hope you were interested in some of the other things you had. And if you were, hit the like button. If you're not subscribed, do that. Hit the notification bell. Probably going to have another live stream midday with Mark on Friday. And then, one other quick point of note that I think you should pay attention to. We're going to have a talk with somebody from Options Metric about dispersion trading, correlation and dispersion. You don't have to trade it to be interested in it, and we're going to be talking about that a week from this coming Friday on the live stream then, also with Mark, but with somebody from Options Metric, so I hope you tune in for that one. And in the meantime, thank you very much for watching.